Welcome back to Investing Talk Podcast.
Great to be back.
Today, we're really zeroing in on something huge, a massive structural shift happening right now.
Absolutely. We're calling it the AI Capex arms race and financial reckoning.
Yeah, it's all about these unbelievable capital expenditures, the Capex, that tech giants are pouring into AI infrastructure.
And these are companies we always thought of as, asset-light software platforms.
Exactly. But now they're building factories, essentially, digital factories. And it's changing everything, their balance sheets, the market, even their whole business model.
It's a fundamental shift, moving from that platform model to something more like an industrial giant. And that carries some serious risk.
Definitely.
Yeah.
So look, if you find this discussion valuable, please do hit subscribe, like the content. It really helps us out.
And we genuinely want to hear from you.
Yeah, absolutely.
Yeah.
If there's a specific company, maybe one you're invested in or just curious about, and you want us to dig into their AI Capex strategy, drop the name in the comments below.
Okay, so our goal today is to walk you through what the sources are saying about this whole escalation. We'll start with the initial shockwaves.
Like that Oracle moment.
Exactly, the Oracle surge, how it literally changed who the richest person was, even if just for a day. Then we'll look at the global strategies, who is winning right now in the supply chain.
The shovel sellers.
Right. And crucially, we need to tackle the big question. Can these companies sustain their sky-high valuations when they pivot from being asset-light to, well, asset-heavy?
All right, let's dive in. That Oracle event really seemed to crystallize things.
Yeah.
September 9th, 2025.
Yeah, they announced their Q1 2026 results, and the headline number was this massive $450 billion in remaining performance obligations, RPO.
Which is basically what? Book future revenue.
Pretty much. It shows the sheer size of their order book, mostly for AI cloud services, and the market reaction, instantaneous.
How big was the jump?
Oracle's market cap went from about $700 billion to nearly $970 billion overnight.
Wow, so a $270 billion gain, just like that.
To put that in perspective, that single-day gain was like adding 3 Meituans, the Chinese delivery giant, to Oracle's value.
That's wild. And then there's the Larry Ellison story.
Oh, yeah, the anecdotal peak. Oracle's co-founder, his personal wealth jumped by $100 billion.
And for a moment, he actually overtook Elon Musk.
Briefly, yeah. Became the world's richest person. I think the next day Musk edged back ahead, but still. It just shows how intensely the market wants to reward commitment to this AI race.
But here's the slightly ironic part, right? The actual spending increase wasn't that enormous compared to the market reaction.
Exactly. That's what's fascinating. Oracle only raised its Capex guidance for the fiscal year from $25 billion to $35 billion.
So a $10 billion increase in planned spending.
Led to a market value surge of over $200 billion. It tells you the market isn't just valuing current earnings, it's placing a massive premium on the commitment to spend on AI infrastructure, seeing it as the ticket to future dominance.
That Oracle signal basically told everyone, spend big on AI, get rewarded. And it became a global thing, fast.
Absolutely. A consensus formed almost overnight. You have to invest. And there's a political angle, too. Sources mentioned a White House dinner, September 5th.
Right, where tech giants were kind of showcasing their commitment, seeking approval through investment plans.
It underlines that this isn't just business strategy, it's almost national strategy now. And that's where you get these eye-watering numbers. Mark Zuckerberg announcing Meta's plan.
What was the figure again?
At least $600 billion by 2028 on data centers and infrastructure in the U.S.
$600 billion. I mean, that number just resets the scale of what it means to be a major player.
And it's not just the U.S. Look across the Pacific.
Alibaba, right.
Yeah, they unveiled a plan for over RMB 380 billion. That's what, over $50 billion U.S. in AI and cloud over the next 3 years.
And a market like that, too.
Definitely. Alibaba actually stood out. It was the only one in the Hang Seng Food Delivery Index to open higher around earnings season, hit a stock price high it hadn't seen in nearly 4 years.
So the driving force here is just FOMO, fear of missing out.
Pure, uncut, capitalistic FOMO. Since ChatGPT basically landed, AI Capex is viewed as essential. It's like a call option on future relevance.
And shareholders are actually preferring this spending over, say, stock buybacks.
Right now. Absolutely. They see it as reinvesting in growth, maybe even survival. Missing the AI wave feels like an existential threat to these companies.
Okay, so the money is pouring out. Where does it go first? The supply chain.
Exactly. The classic picks and shovels play.
Like in a gold rush, sell the tools, not necessarily dig for gold yourself.
Or the rebar and cement suppliers during a property boom. They win first, almost guaranteed. So who are today's guaranteed winners?
The builders of the digital infrastructure.
Precisely. Data centers are the new foundation, and the numbers are startling. As of June 2025, get this, U.S. spending on data center construction.
Yeah.
It hit $40.1 billion, seasonally adjusted annual rate. That's nearly neck and neck with spending on general office construction, which was $44.2 billion.
Wow. So we're building almost as many data centers as office buildings now.
Pretty much. The internet is becoming physical real estate in a way.
And when you look at the companies supplying this build-out, their numbers are just explosive.
Oh, absolutely. Take Cambricon, a chip seller. Their half-year revenue up 43 times.
43x. That's not growth. That's a feeding frenzy.
And they flipped from a net loss to a net profit.
Incredible. What else?
Up and down the stack. Optical modules, think companies like Zonggino Light revenue up almost 37% year over year.
Solid.
And then look at someone like Victory Giant Technology, a leader in PCBs, printed circuit boards. Their net profit grew nearly 370%.
370%.
And the share price up fivefold within a year.
Yeah.
These are the guys seeing the cash flow right now. Tangible proof.
Okay, so massive spending, supply chains booming. But how are these tech giants actually funding this without tanking their current profits? That's the big question.
Well, this is where the strategy gets, let's say, intensely focused. They're fundamentally pivoting their cost structure.
How so?
They're actively replacing operational expenditure OPEX with capital expenditure CAPEX.
So cutting people costs mostly.
Yeah.
And using that money to buy machines and infrastructure.
In simple terms, yes. The bet is that AI capabilities fueled by this CAPEX will eventually automate enough tasks to significantly reduce future labor costs.
It's kind of ruthless financial balancing act. Protect today's profits, pump up tomorrow's valuation with AI spending.
And the evidence is clear that this is happening simultaneously. Look at the timelines. Intel announces a 15% workforce cut in July 2025. Microsoft starts its second round of layoffs that same year.
Right.
And there were reports, I think, from a Google VP in August 25 that the number of managers was down something like 35% compared to the year before.
So they're cutting OPEX dramatically while ramping up CAPEX spending.
It's a deliberate transformation. Layoffs keep the current profit numbers looking okay, which markets like.
While the massive CAPEX spend signals future growth, which markets also like right now.
It's presented as a win-win, balancing the short term and the long term. Mark Zuckerberg was quite open about it, basically saying they had to control costs and reduce headcount to fund these huge long-term AI bets.
It feels precarious, though. You're betting heavily that the machines will deliver productivity gains fast enough to offset the loss of human capital and the sheer cost of the machines themselves.
Oh, absolutely. Which brings us to the reckoning part. The potential financial reckoning.
This is the core concern, isn't it? All this cash being spent today on data centers, on GPUs, it doesn't just disappear.
Nope. It lands on the balance sheet as assets, and then it starts to depreciate. Year after year, it turns into depreciation and amortization expenses hitting the income statement.
And if those expensive assets aren't generating enough new revenue,
then those D&A expenses start eating into your profits severely. This is the central risk.
Is there any way to quantify the needed return?
Sequoia Capital took a stab at this back in 2023. Their calculation was pretty sobering.
What did they find?
They estimated that for every $50 billion worth of NVIDIA GPUs sold, the buyers these tech giants would need to generate over $200 billion in new revenue just to pay back that initial investment.
$200 billion in revenue for $50 billion in chips. That's a 4x return needed just to break even on the hardware.
Roughly, yeah. And back in 2023, they calculated this left an annual revenue gap of over $125 billion that companies needed to fill from their existing profitable businesses. That gap's likely only grown since then as CapEx has exploded.
We can see that imbalance playing out now, right?
Yeah.
Microsoft.
A prime example. Since ChatGPT really took off, they've piled up over $140 billion in CapEx.
Okay, massive spend. And their AI-specific revenue.
As of, I think it was fiscal Q2 2025, their annualized AI revenue had just crossed $13 billion.
So $140 billion spent for $13 billion in annual run rate revenue so far. That's a big gap.
A very big gap. And look at Meta, perhaps the ultimate symbol of this transformation.
From asset-light darling to
seriously asset-heavy. Their ratio of fixed assets, property, plant, equipment, basically to total assets, it surged. End of 2020, it was around 28-29%.
Okay.
By the end of 2024, it hit 44%.
44%. Wow. How does that compare to, say, a car company?
It actually surpassed Tesla's ratio at that point. Tesla was around 38%.
So Meta, the social media company, became more asset-heavy on paper than Tesla, the car and battery manufacturer.
That's what the numbers showed. It signifies this massive shift. These internet companies, once envied for near-zero marginal costs and platform effects,
Are now essentially running factories. Data centers are the production lines, chips are the equipment.
exactly. And they're inheriting all the financial challenges of traditional manufacturing. Depreciation, maintenance cycles, the constant risk of technological obsolescence.
Challenges their old valuation models, built on software margins and scalability, were just never designed for.
So where does this leave us? To understand the risk, history is maybe our best guide. Think back to the late 90s, the dot-com boom.
Right, another period of absolutely insane infrastructure spending.
But the focus then wasn't AI chips, it was...
Fiber optic cables, laying glass all over the world, millions of miles between 96 and 2000.
Exactly. Companies like WorldCom, Global Crossing, they borrowed billions to build out that network.
And
Bankruptcy, 2002. WorldCom with $41 billion in debt. Global Crossing with $12 billion. Wiped out.
But here's the crucial historical lesson, right? The infrastructure did get built.
It did, and that massive fiber network paved the way for the next generation, for Amazon, for Google, for the whole Web 2.0 era.
So the pioneers who laid the tracks often didn't survive, but the tracks enabled future empires. Could that happen again?
It's the key question. The big difference today, maybe, is that the current giants, Google, Meta, Microsoft, Amazon, have incredibly profitable core businesses. Search, ads, existing cloud.
They can bleed cash on AI Capex for much longer than WorldCom could bleed cash on fiber.
Potentially, yes. They can afford to be more resolute, spend for longer, which leads to this split we see among investors now.
Yeah, two clear camps seem to be forming.
On one side, you've got the trend followers, the momentum investors. They're betting on the narrative, rewarding every bigger Capex number, chasing the trend.
On the other.
The value investors, maybe the skeptics, they're waiting for the hype cycle to peak, looking for the bubble to pop, waiting for truly killer applications that actually justify these costs.
So here's a final thought to leave everyone with. This immense Capex spending, regardless of whether it bankrupts the first movers.
It will undoubtedly drive down the cost of AI services across the board. More infrastructure means more supply, more competition.
Right. It democratizes access in a way. So the provocative question is, even if AI doesn't deliver the astronomical returns these companies need to justify their spending, does this massive build-out represent a kind of necessary destructive creation?
A painful investment phase that, like the fiber build-out, lays the foundation for the next generation of truly great tech companies, even if some of today's giants falter under the weight of becoming asset-heavy.
That's the multi-trillion-dollar question. Thank you for joining us for this really essential conversation today.
It's critical stuff. We absolutely have to keep watching that ratio, the Capex going out versus the actual AI revenue coming in. That's the metric that will tell the story, end of the day.
Couldn't agree more. And remember, if there's a specific company's AI spending strategy you want us to focus on next time, let us know in the comments. Don't forget to like and subscribe. We'll catch you on the next one.